Today we're looking at an analysis report that it had a number we couldn't ignore, a suggested upside of 279%.
It's a huge number. I mean, it creates this incredible paradox right away, doesn't it?
It really does. You see a stock, NXXT Inc., that's NXXT, trading at just $1.45.
And then you see Wall Street analysts putting a $5.50 price target on it. The immediate question is this just wishful thinking, or is there something real here that the market's missing?
Exactly. So that's our mission today. We're going to unpack this report, try to figure out why this strong buy consensus even exists, and maybe more importantly, what are the risks that are holding it down?
Well, the report frames it very clearly. They see a company that is, and I'm quoting here, massively undervalued based on its actual performance.
Okay, so it's all about the data.
It's all about the metrics that are supposed to justify that huge 279% figure.
All right, let's start right there then. Let's just do the basic math, because that's what makes this so compelling.
Go for it.
You're looking at NXXT today. It's about $1.45. The analysts project its value at $5.50.
That's nearly a 4x return, and that's the hook. But, it's not just one analyst being bullish.
No, the report stresses that it's a strong buy consensus.
Right, that's where it gets really interesting.
And that's where I start to get a little skeptical, We've seen analyst consensus before. What's so special about a 100% buy rating on a stock this cheap?
It's the unanimity. You very rarely see every single analyst agreeing on such a massive upside for a stock under $2. The report even says so. It suggests they're all seeing the same undeniable data points.
Okay, so they're all in agreement. But what's the engine here? What makes them think this little company is the hidden gem of 2026, as they put it?
It all comes down to one thing. The foundation for this entire valuation is revenue growth.
And when they say growth, they're not talking about 10 or 15%.
No. The analysts are setting that $5.50 target because they believe the company is in what they call hyper-growth mode.
And we have the specific number, which is, it's almost hard to believe. The company's revenue is growing at 271% year over year.
271%. That's the metric that just changes the whole equation. A healthy, established company might be happy with 10% growth.
Or 20% on a great year?
Exactly. So a number like 271% suggests some kind of massive disruption is happening. The company is accelerating so fast that the old valuation models just can't keep up, and that's why the price is lagging behind the performance.
That makes sense. The models have to reset. But growth has to be smart, right? It can't just be growth for growth's sake. Yeah. How are they doing this?
This is the core of the strategy, and according to the analysis, it's a brilliant pivot. They're bridging the gap between their traditional mobile fueling business and the future, which is AI-driven renewable energy infrastructure.
Okay, that's a mouthful. Let's unpack that a little for everyone listening. What does that actually look like?
Yeah. Well, think about it. Their old business was basically delivering fuel, but they saw where the world was going. Renewable energy projects, solar farms, wind turbines, they're often built in remote places, right? Far from the grid.
Right, so you need mobile power solutions just to build and maintain the things that are supposed to be making power.
You've got it. And the AI part is their sort of secret sauce. The report suggests they're using AI to predict demand, to optimize fueling and charging routes for all this remote equipment. They're not just selling fuel anymore, they're selling the smart logistics to power the entire renewable energy build-out.
So they're taking what they already do well, mobile logistics, and applying it to the fastest growing part of the energy sector, using AI to make it super efficient.
That is the bull case in a nutshell. And analysts are saying this pivot is clearly paying off. You can see it in the revenue. The whole idea is that the market, trading the stock at $1.45 just hasn't realized this shift has happened yet.
They're still pricing it like an old school fuel company, not a tech-enabled growth play.
That's the argument, a huge distinction.
Okay, so if the fundamentals are that strong, that 271% growth is real, we have to talk about the stock price itself. Why is it so cheap? The report calls the technical setup a textbook golden opportunity.
Right, and that opportunity exists because the stock has cooled off so dramatically. It hasn't been tracking with that revenue growth lately. We know it hit a 52-week high of over $4.
And a drop from over $4 to $1.45. I mean, that usually sets off alarm bells. Why does the analysis see that as a chance to buy the dip and not a warning sign?
Because of what the stock has been doing recently. Analysts are looking at the charts and seeing that the selling seems to be over. The report says it has found solid support in this tight range around $1.40 to $1.50.
And for anyone listening who doesn't stare at charts all day, what does solid support really mean here?
It means that every time the price dipped down to, say, $1.40, a wave of buyers came in and pushed it right back up. They absorbed all the selling. The report points to one specific day where it touched $1.40 and then bounced to close green.
Ah, so that's a strong signal. It's like there's a floor under the price.
A floor that big money seems to be defending, yes.
And we also have to talk about the size of the company. NXXT is a small cap stock. It's got a market cap of only around, what, $195 million?
That's absolutely critical. The low market cap dictates the speed. You always hear that small caps move fast, and it's not just a saying, it's about liquidity.
Explain that. Why does a smaller company move faster?
Well, think of how much money it takes to move the needle. For a $10 billion company to go up 10%, you need $1 billion in new investment. For a $195 million company, you need way, way less.
Because there are fewer shares out there.
Fewer shares and fewer giant funds holding them. So if good news hits and the market starts to notice that 271% growth, the move to $2, $3, even that $5.50 target, the report says it could happen quicker than you think. The small size is like built-in leverage.
So you have explosive growth meeting a technically attractive price point. It sounds almost too good to be true, which means we have to get to the real talk, as the report puts it.
Absolutely. The risk.
If everything is so great, why isn't this stock already at $3 or $4? What's the balancing act here?
The tension here, the thing that's keeping the stock pinned at $1.45, is one big factor: cash burn.
Right. If you just look at the bottom line, the company has negative earnings. It's not profitable.
Which is a huge red flag if you take it out of context, but the analysis gives it that context. NXXT is acting like a high-growth tech startup right now. They are spending money aggressively to build out that new infrastructure.
So all that money is going into the AI platform, the specialized equipment,
Right.
everything they need to service this new renewable energy market. It's an investment phase.
It's a pure investment phase. They're choosing long-term market dominance over short-term profits. So the negative earnings aren't from a lack of sales, they're from the cost of building the future business.
But that's the classic question, isn't it? Building is expensive. How long can they keep burning cash? Analysts get this wrong all the time with growth companies that just run out of money.
And that is the core of the bet. It's what the report calls the bull case defense. The analysts are not ignoring the cash burn. They are making a calculated gamble that the revenue growth, that massive 271% number, is going to outpace the spending.
It's a race then.
It is a high-stakes race. If they can keep signing up new business faster than their costs are rising, then they hit profitability and they hit it fast.
But if that revenue growth slows down for any reason, or if their costs spike, then the risk becomes very real.
And the current price is justified.
Yeah.
The whole thesis assumes they will achieve a kind of escape velocity from those negative earnings, powered by sales growth.
That timing is everything. It seems like the market is giving you a discount because of today's unprofitability.
Right.
But the report is saying if NXXT pulls this off, getting in at $1.45 will look like a steal.
It's an investment in execution speed. You're taking on the current balance sheet risk because the top-line growth gives you a pretty compelling reason to believe in the future.
Okay, so let's just quickly bring it all together. Let's synthesize the 3 big data points from this analysis that are driving this whole thing.
First, you have the conviction, that 100% strong buy rating. It signals all the analysts are on the same page, which is rare.
Second, you have the fundamental engine, that 271% year-over-year revenue growth, which is being fueled by that really smart pivot into AI and renewables.
And third, you have the result of all that. The headline grabbing $5.50 price target, a 279% potential return from a stock that looks like it has found a technical floor.
So at the end of the day, the analysis boils the whole thing down to one essential question for you, the listener.
Yep, it's this. Do you believe that this insane rate of revenue growth can get the company to profitability before the cash burn becomes a problem? It's really a story about managing resources under extreme pressure.
And that leaves us with one final thought to chew on. In these brand new high-growth industries, like this AI-driven energy logistics space, that initial spending, that cash burn, is the price of admission. It's what keeps competitors out. So how do you really measure the exact moment when that spending stops being a risk and flips over to become locked-in future value, making a $1.45 price tag obsolete? That inflection point is what determines if NXXT is a true hidden gem or just another ambitious story.